Let's move toward the disclosures under paragraph 28 of IFRS 8. This disclosures is very much relevant because it provides the reconciliation between the amount reported under the reportable segment items in the segment reporting the report versus the figures that is actually reported in the financial statements. So it's the measurement difference we have already discussed. These are the reconciliations, which means it is specifying what are the factors that lead to differences between the profit or loss, between the assets if it is reported, between the liabilities if it is reported. So in case of what I feel is like in case of non-disclosure for the assets, because it assets disclosure is not mandatory provided these are provided on a regular basis to the CODM. If we are not disclosing assets, then in such a case I don't feel there is a requirement for the reconciliation. The same is applicable for the liabilities. So let's move on and let's discuss and let's see how the reconciliation would look like. Note number 8, this is a reconciliation that I would like to say. Revenue, the total reportable segment is this much. Revenue from the other segment. I've discussed in my previous video is that I'll cover up this topic because we've discussed that the reportable segment does not include the items that covers under the other segment. It's just a plug-in variable. So we need to plug it in the reconciliation to tally it with the reported figures under the financial statements and any inter-segment revenue, because inter-segment revenue won't come up in the main financials statements because these are primarily ignored at the time of consolidation. The fourth one would be the elimination of the discontinued operation, because for the discontinued operation we provide a line item called profit after tax in respect of the discontinued operation rather than including it in the main financials. The same for the profit before tax for the assets and for the liabilities. Along with that, we need to disclose this for any other material items under paragraph 97 of IAS 1. We've discussed this earlier. Any interest expense, interest income, capital expenditures. So all those things we need to provide what's the difference between the reportable segment and the item that is presented in the financial statements. So we've covered this part. Now let's focus on point number 9, that is IFRS 8.29. If there is any internal reorganization, for example, if there's an M&A or if there's a spin-off, it may lead to change in the segment reporting. If there is a change in the segment reporting, or if there's a change in the entity itself. For example, there was a retail business which was spun off or which sold to another party for an XXX sum. Then in such a case, that segment won't be a part of the entity, and that won't be a part of the entity. So how do you need to record in the segment reporting? I will just give you the crux. The first, you need to disclose both the impact with the M&A and without the M&A for both the current and the prior year. And if it is not possible, or if there's no cost benefit for that, then in such a case, you need to disclose with the new you need to disclose it with the current actual figures, and you need to provide a disclosure that how the reporting would have done if there would be any kind of reorganization. So it's both on the new basis and on the old basis. So this is basically a requirement on 8.29 and 30. So these two disclosures will come up when there's these internal reorganization.